Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Dollar is still very, very weak, very large dump, not since November of 2022 when they came in with massive central bank intervention. So wouldn't be surprised for a little bit of a bounce here. 104, maybe all the way up to 105. A government shutdown, we'll see what happens. But the point is money's moving home. So I wrote about that, and I wrote about it not just once, but actually twice. Once is just this week because of the fiscal stimulus that's starting. Japan, Germany, EU is committing. Now, I don't think it's going to work. I think, they're going to have sovereign debt issues in the next year or two. But for right now, foreign investment in the U.S. is not wanted. Trump, Bessent, Musk, right? They have the trifecta of lower dollar, lower yields, lower oil. They're pushing oil down for sure, but not too far, too fast. That'd be disruptive. But they are still talking $50. That's what Navarro said the other day. Bessent is very focused on bringing down treasury yields in support of the bond market, and that is going to be their playbook at every opportunity. And the dollar, of course, falling is not a surprise, but because they want less demand of dollars. They don't want to lose this exorbitant privilege, but they will slowly, and that's okay if the dollar comes down from a very overvalued place to help exporters of the U.S. in the future. But for right now, there is going to be some short-term pain as most likely the basis trade gets unwound. So money is going home. The basis trade is mostly levered hedge funds that hold on to this treasury short and push Mag 7 concentration risk. That is something that they very likely will start to unwind, and it will be helped by a yen carry trade unwind part 2. And we're getting kind of close to that triggering. It's already triggered, but I mean really picking up speed. So in any case, I wrote about this dollar dump and some of the reasons that it's being helped, and just a reminder that there's 17% of U.S. equities are held by foreigners, and they're absolutely incentivized here to sell. So we got a no stay of execution there. The rate spread differentials, I focus on the U.S., Japan, but here's another one, really good one. 10-year interest rate differential with the euro versus Germany is also a very large spread. Anyway, long story short, I did a big piece on this before where I talked about the reason that we have been long stocks, because it's basically short the dollar, relatively speaking, real versus nominal. And I go into that explanation. So this is a dig into real versus nominal value of the dollar. This is basically just flat out dollars going home as it relates to the stock market selling and taking your chips elsewhere, because there are higher yields. There's also tariff risk. There's also, again, Trump, Bessent, Musk, very coordinated. They want the bond market protected, so stocks are coming under distribution. And it hasn't even picked up speed yet. Like, this has been a very controlled selling. We have almost a mild recession is what they're gunning for. It feels very likely that we get that pulled forward because of the tariffs driving down demand, etc. So this is definitely money going home, long story short. All right, so as dollar is falling, also surprising that gold hasn't fallen more. I mean, it hasn't risen more, right, with that outsized move. But we have the kind of stochastic sideways, and we have the every rip just creates a dip, every short the rip, and we just keep rolling over. So we haven't really seen fast selling, and that means we haven't seen a volatility spike. But there's nothing in my read that says volatility is done going up. Nothing. And again, this is on a 2-hour, but you can kind of see that we just keep getting repelled. And the only reason why oil is bouncing is because of the SPR news. So we've got to look at Japan now very seriously, because Trump is out last night and he is talking about tariffs on Japan. Remember, they're kind of a hot potato as it relates to their housing of military bases for the U.S., but also friendly, a big, huge, important friendly as it relates to proximity to China. So bonds are getting bid again, and that's the safety. That's also recession risk pulled forward. Tariffs on Japan would cost the U.S. a lot, but it would also also trigger even more yen carry trade unwind, in my humble opinion. So I've written about that before, and I think it's time to revisit that and protect against that. So the yen carry trade unwind had already triggered. I mentioned that actually a few weeks ago, but it's the rate of change that determines the velocity of the equity selling. So this is why I study very, very closely, not just what the dollar's doing, but what oil is doing, because it impacts, and our rate differential with Japan impacts that fractal with SPY Qs. Again, the basis trade is hedge funds shorting aggressively US Treasuries and buying aggressively the VIP stocks, primarily Mag 7. That unwind is what we had back in July. So we saw that forming, that yen was going to start rising, and then it started picking up speed, and then the 10-year yield in the US dropped precipitously, right down to that 3.6. So this is unwind that we had in equities on levered short treasury long Mag 7. It reversed. It's going to happen again. It's been very controlled. Puts are the most, in history, whatever. Well, that's because folks are really, really, really protecting. Anyway, this differential continues to fall. This is on a 2-hour, just to kind of show you. This is January 13th where we're headed. That's my humble opinion. And nothing here has shown a little bump here, a little bump here, a little bump here, but it keeps ratcheting lower. So this is the rate spread differential US Japan, and that just means you hold on, you just keep holding on to those shorts. This is gold continuous. We haven't done any head and shoulder yet, but as you can see, dollar yen has definitely broken through, didn't even get up to 152. Like that was the risk. It couldn't. It's basically following the market lower. And that's the risk that we have a yen trigger even more. Here's that volatility spread, and we are still not even at August lows or that big shake and bake of 3% down day with SPY. When we get a 3% down day, we'll trigger even more volatility. We're not there yet. Slow. It's really, 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 really slow. Look at the intraday volatility we have been having is up here, right? So very, very strong, just like the July carry trade. It's been very, very strong. And we are in negative gamma, and we have been in negative gamma, and we're going to stay in negative gamma until we get some relief here. And there's no headline relief at all. Hedge funds have been selling aggressively. Like, look, historically, this is really aggressively. Some reasons for it. I personally would just love to see it flush, but it has been very controlled. I have been assessing all kinds of VIX instruments, UVIX, tail risk, the 9-day, my ratio, VIX itself, SVXY, VVIX, every single instrument of volatility that I'm studying is still intonating higher. And NASDAQ has closed below the 200-day moving average. Usually this means we're going to have nasty little 2-week chop in at least 2 weeks of a chop around here, potential flush, but we haven't flushed yet. That's all. So we're waiting for a flush, and we got some reasons that might help us get there. We've got basically CTAs that have a whole bunch to sell. Basically, the stock buybacks that come in, they counter, which are automatic oftentimes, they counter with the CTAs that are also selling. And they're forecasting, for example, if we have negative 2.2, they sell 100 billion for the sale over the next week. If the leverage falls like it did, in other words, levels start going back to the August 2024, they'll have even more to sell, 200 billion total. If we were to go all the way back to the leverage seen in 2022 lows, we'd have, 350 billion. So a lot of this is that market structure of quants where they are price insensitive. That's something to keep in mind. And then Morris McElligott, the quant brain that I follow, is saying, hey, Trump administration may need an engineered recession to drive disinflation, right? That disinflation impulse that I called this a few weeks ago before we fell 10% in the Q so far. This seemed like it was kind of slow motion train wreck. It still is. We have not crashed. We have not flushed. VIX is still very strongly bid, which may help dampen the spikiness of it. But we get a yen carry trade rate of change, in other words, a speed in the unwind, everything will change. But right now, definitely already have a rate cut expected for March. FOMC meeting in 2 weeks, less than 19th. And maybe they do a double, right? Maybe they do a double like they did in September. Anyway, we definitely have dollar weakness. It's negative wealth effect. Money's going home. We have falling stocks and crypto, even the crypto reserve, even the SPR promise of investment. We still have weakness in the oil patch, in equities, and in the dollar. And yields today are also kind of coming back down a little bit. But for right now, I'm watching the yen carry trade as a really, really important level for discussion and for follow.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.